welcome back to Onlytax, where we give you the naked truth about how the tax system really works. No fluff, no confusion, just real mistake and real solutions. Today, let's give it applause and let's welcome back Alisa!
Hey everyone.
So I have a question for Alita, because our audience has been asking Alita. You were gone for a couple episodes. Were you gone because you were busy doing taxes, or were you gone because you were out partying somewhere?
No, of course I'm not partying. And yes, it is because I got a lot to do with our tax season and all. So I hope they understand. But now I'm definitely back and I'm so happy to be back for our audiences.
Excellent.
Perfect, perfect. All right. So today, with our two complete accountants, Jason and Alyssa, they're going to spot the mistakes in real life real estate scenarios. I'll give them the scenarios and let's go straight into today's segment. Spot the mistake. Scenario number one, adding the son to the title with a twist. So Robert owns a rental property worth $500,000. He adds his son to the title, thinking it avoids taxes. But here's the twist. Robert still lives in the property, collects rent from tenants, and occasionally makes major improvements. Jason and Alyssa spot the mistake.
Yeah, so I would say that one of the first things that comes to my head is by adding his son to the title, that's going to change the allocation of the depreciation and also the capital gains in the future. And also, when they do sell the property, both the son and also Robert need to be taking into consideration depreciation recapture, which is when you get taxed on the depreciation that you previously took in previous years.
Exactly, Jason. Now the son has a partial ownership of the property with ongoing rental activity. They need to note that that creates reporting and tax complications as well, the family that they may not anticipate.
Yes, because at least correct me if I'm wrong, but now wouldn't both the son and Robert need to have a Schedule E on their
Yep.
tax return, right?
Yep. Because of their allocations and the ownership of the property or rental property. Yeah.
All right. So it's not just about ownership, it's about timing and activity. What seems like a simple title change now can cost thousands later. So, scenario number two, guys, personal expenses versus rental with a sneaky detail. Okay. Not a sneaky, sneaky, okay? Just a sneaky. Linda Linda stays at her rental property for a week while overseeing renovations. During that week, she buys a new TV for the rental and also rents a luxury car to visit suppliers. She deducts everything as rental expenses. Jason and Lisa spot the mistake.
Yeah, that one's a bit tricky, because part of the expenses could be legitimate because, as she deduct everything as part of the rental expenses, but like the TV, if it's for rental, but renting the luxury car, I think that's personal or excessive and unnecessary and likely not deductible, Linda. Right, Jason?
First question that comes to my head, you guys, is I wonder what kind of luxury car she rented out. So I wonder if that Lamborghini and she's pulling up on her tenants collecting rent on a Lamborghini. But in all seriousness, for an expense to be deductible under the IRS tax code, it has to be ordinary and necessary. So I'm not sure that renting out a luxury car for this particular purpose would be considered ordinary and necessary. But with that said, though, she can look into deducting her business miles, though. That would still be legitimate. And also, if that TV is for the rental and it's going to be used for by tenants after she
Yeah.
leaves in a week, then that can definitely be a business expense.
Okay. So, Linda, please, you have to separate reasonable property related costs from personal indulgence. Okay. Separate business and pleasure always.
Yeah.
That's where
Correct.
many investors slip up. So, right? You're right. Okay. Lastly, scenario number three, renting to family, but complicated. So, David rents his vacation home to his daughter. She pays 25% of market rent, but he also lets her use a boat he owns as part of the rental. He doesn't report the rental income. Jason, Elisa, spot the mistake.
Yeah, so first thing is first is that if you charge below market rent, and that can trigger some complexities and some scrutiny there. And also another thing is that you have to report the income. Because if you don't report the income, the IRS has no statute of limitations on how far back they can go and audit you.
Correct. And even with family, we can't ignore tax rules like partial rent, extra perks, and in-kind benefits. All needs to be considered when we are reporting income because the IRS looks at the fair market value. We have to remember that. Yeah.
All right. So even a friendly family rental can become a tax trap if you don't handle the numbers correctly. So business is business, guys. All right. And that's it. That's our spot the difference. Three tricky real life real estate mistakes spotted by our accountants, Jason and Elisa. Remember, real estate isn't just buying property. It's knowing the rules, documenting properly, and avoiding traps. Okay. And thanks again for watching. If you guys have like a video, a TikTok, a clip, an article that you want us to react to, send it our way and we'll make sure to look into that. Again, thanks for watching Only Tax, where we give you the naked truth about how the tax system really works.